Welcome to the 2014 Birkenroad Reports coverage of Conns Inc. This is Rob Kramer, analyst for Conns, along with Sebastian Mesa, Natalia Mestizo, and Katie Whalen. Conns is a furniture and home appliance retailer traded on the NASDAQ and based out of Beaumont, Texas. We used a discounted cash flow analysis, the price-to-book value ratio, and the enterprise value to EBITDA ratio in our valuation to come up with a 12-month target price of $43 and an investment rating of market outperform. In today's presentation, I will begin by giving you a summary of Conns as an investment. I will then move on to a description of the company, followed by a breakdown of its revenues and financial performance. I will then finish the presentation with an investment thesis where I will discuss factors affecting the company. Over the past 5 years, Conns has had a total return of almost 400%. Between November 2009 and December 2013, Conns stock saw an increase in price of more than 1,000%, but in the following months, the stock lost value quickly. Between December 2013 and March 2014, the stock declined in value by more than 59%. This was followed by a period of high volatility for the company's stock, where its price fluctuated between $40 and $50. This period of high volatility was followed by another decline in the stock price of about 34% between August and September of 2014. On November 13, 2014, the stock closed at $32.29. Beginning in 2010, Conns made a business decision to cut costs at underperforming stores and to increase the company's profit margin by altering its product mix. The company changed its product mix from inexpensive, lower-margin products to more expensive, higher-margin ones such as mattresses and furniture. During subsequent years, the company's stock price significantly outperformed the market and increased in value by more than 1,000% from December 2010 to November 2013. The company saw its first large setback in the fourth quarter of 2013. Between December 2013 and March 2014, the stock price declined by more than 59%. This price action was followed by a subsequent sharp price decline during August 2014. Both drops in stock price were caused by a company's failure to meet earnings expectations, primarily because of large increases in the company's delinquent accounts receivables. After the first drop in stock price, the company tried to get its accounts receivables under control, but that process takes time, as evidenced by the second dip in stock price. To address its delinquent accounts receivables issue, the company dropped its no-interest lending programs and created stricter lending policies for subprime borrowers. Going forward, these actions should put Conns back on track and lead to lower rates of delinquent accounts in the future. Conns is a retailer of home appliances, consumer electronics, mattresses, and furniture. In 2010, the company changed its focus to higher-margin products such as mattresses and furniture. To increase sales of these products, the company introduced its Home Plus format. Home Plus stores are larger in size than traditional Conns locations and emphasize its mattress and furniture offerings. The introduction of the Home Plus format and subsequent increase in sales of higher-margin products has increased the company's gross margin significantly over the past few years. As of September 22, 2014, Conns operates 89 stores across 10 states, predominantly in the southeastern United States. The company has an aggressive expansion plan and hopes to open an additional 15 to 18 stores through the fiscal year ending January 31, 2016. The company will continue to target densely populated neighborhoods filled with its target demographic, working individuals earning between $25,000 and $60,000 per year. This expansion strategy lends well to the company's in-house financing program. In the quarter ended June 31, 2014, the company made about 20% of its revenue from its in-house financing program. This means that Conns relies heavily on customers that borrow from the company to purchase its retail offerings and then pay interest on their purchases. Conns has two independent operating segments, retail and credit. The retail segment accounted for 84% of revenue in fiscal year 2014, and the credit segment accounted for 16%. The retail segment draws its revenues mainly from product sales, while the credit segment draws its revenue from interest payments. Although the company manages its retail and credit segments independently, it offers in-house financing at all of its stores. For the fiscal year ending January 31, 2014, about 77% of retail sales included an in-house financing plan, while only 8% of sales were paid for outright. The in-house financing plan is Conn's main competitive advantage and allows consumers with less than stellar credit to receive financing for retail products that they may otherwise not be able to afford. This gives the company large accounts receivables, and an increase in delinquent accounts could severely hurt the company, as it did in the third quarter of fiscal year 2014. Our regression model is based on a historical 30-period data set with 6 independent variables. This data set includes historical data as of the first quarter of fiscal year 2008 until the second quarter of fiscal year 2015. Because consumer retail companies experience cyclicality, we use dummy variables to account for the cyclical nature of Conn's sales. The company's period of highest sales is quarter 4, and its period of lowest sales is quarter 3. In addition, we use net property, plant, and equipment as a proxy for store count and retail space. Historically, net property, plant, and equipment has been very highly correlated with the company's sales. As the company expands, it has more retail floor space and is able to sell more products. We also use 2 independent dummy variables to explain hurricanes and the recession of 2008 and 2009. These exceptional events had a significant impact on revenues, and we did not want them to affect our regression moving forward. Finally, we use disposable income as a macroeconomic proxy. This variable has been very highly positively correlated with Conn's sales, as more disposable income leads to more consumer spending. We use the revenue regression model to forecast up until the fourth quarter of fiscal year 2016. After 2016, we used a linear growth model to forecast revenues. We expect steady growth related to steady new store openings and increases in disposable income. In both the fourth quarter of fiscal year 2014 and the second quarter of 2015, Conn's failed to meet its earnings expectations. These failures to meet expectations have led to a drop in Conn's stock price of more than 86% since December 2013. Conn's failure to meet earnings expectations in these 2 quarters has primarily been caused by increases in the company's delinquent accounts receivables. To combat this, the company has changed its lending policies, which will hopefully help bring the company's delinquent accounts to a more manageable level. Beginning in 2010, Conn's made the decision to alter its product mix towards furniture and mattresses to increase its profit margin. In the second quarter of fiscal year 2015, furniture and mattresses accounted for about 30% of sales, up from just 25% in the previous year's second quarter and about 20% in fiscal year 2013. These products are both more expensive and offer higher margins than the products that the company sold previously. For example, in the second quarter of fiscal year 2015, furniture and mattresses offered a gross margin of about 49%, as opposed to the company's average gross margin of about 36% during this period. In the past 3 years, there have been more than 1,500 complaints lodged against Conn's with the Better Business Bureau. The New York Times has published 2 articles this year which detailed some of Conn's controversial practices. For example, some customers allege that the company includes an extra fee for credit insurance that Conn's employees try to hide from customers. The article also claims that Conn's lures customers into making purchases that they cannot afford and is partially at fault for its customers' credit failures. The company must take these allegations seriously, as bad publicity can negatively impact a retail company's top line if it is not addressed properly. On October 6, 2014, Conn's announced that its board of directors had authorized management to explore strategic options for the company. The options include a sale of the company, the separation of its retail and credit businesses, or the slowing of store openings with emphasis on returning capital to investors. Though the company's plan is uncertain, all of its options have the potential to enhance the value of the company for its stockholders.